The Federal Reserve's favoured measure of inflation comes in hotter than expected. Welcome to Market Insight. I'm Ramzan Karamali. Core PCE remained at 2.8% in March. A Reuters poll of economists had predicted a fall to 2.7%. Today's data comes just a day after Q1 inflation and GDP numbers saw investors push back expectations of a rate cut by the Fed. Well, to help unpack all of that, I'm joined by Sarah Hewin, Head of Research for Europe and Americas at Standard Chartered. Sarah, thanks so much for joining us. So what do you make of today's PCE data? Does this mean the Fed might be bringing forward a rate cut?
I think it gives them pause for thought because inflation hasn't been coming down as rapidly as they had hoped. And being stuck at 2.8% is not really on track for the 2% target that they have. I think there is some good news in this report in that the monthly inflation came in at 0.3%. There had been a fear from markets that it could come in somewhat higher than that. But if we break down the data, there's still a problem with services inflation, with so-called supercore inflation, which is services excluding energy, excluding housing. And that's the domestically driven element of inflation that the Fed will worry is being driven by strong US demand. So it suggests that the Fed will be cautious in terms of the timing of a rate cut. I think expectations of a cut in June are very, very weak. A cut in July, which is our own view, markets are not so sure that that's going to happen then.
Now, overnight, the US Treasury Secretary Janet Yellen gave an interview to Reuters and she sounded pretty bullish about the US economy. Is she right to be, though?
Well, the economy certainly seems to be doing incredibly well. If we look at the GDP data for the first quarter of the year, they undershot expectations, but stripping out the impact of net exports, so essentially very strong import growth, we can see a story of strong demand, strong consumer spending, strong investment, residential investment picking up as well, having been very weak and in fact falling for quite some time through much of last year and the year before. So overall, the underlying momentum in the economy still seems to be pretty positive. So I think it is a good story. And of course, the labour market data also suggests that jobs are plentiful and that wage growth is rising. Overall, it looks like a strong picture for the US economy, but that, of course, raises concerns about how soon rates can be cut and indeed whether they can be cut at all this year.
Now, the case for a rate cut by the ECB in June, though, that seems pretty strong at the moment. But after that, the path doesn't seem so clear. And we've had members of the policy committee make sort of comments about how fast they would cut afterwards. What's your take on that?
Yes, I mean, June seems to be pretty bedded in. We had a very clear steer from Christine Lagarde at the last ECB meeting that they were considering June as the start of the rate easing cycle. Since then, of course, the mood on the US has changed, and I think that may be influencing how ECB policymakers are considering their own policy moves. So it doesn't seem to be jeopardizing that June rate cut, but it raises a question about whether they can continue to cut rates subsequently. Even the more dovish members of the Governing Council, some of the more dovish members of the Governing Council have been talking about small, gradual rate cuts, and it may well be that we see a pause in the easing cycle in the third quarter. That's our own expectation, although we still think that there's plenty of scope for reasonable cuts, 100 basis points of cuts altogether this year. That's our central forecast for the ECB.
Now, we had some data out today for the UK. Consumer sentiment seems to be improving. So does that make it easier for the Bank of England to delay rate cuts?
We think that they probably will delay until August. I mean, there are good reasons for cutting rates. In particular, we're likely to see inflation coming down quite substantially at the next couple of readings and indeed at or even below the 2% target. The problem for the Bank of England is that it looks likely that we'll see a pickup in inflation again in the second half of the year. The other issue is that markets are raising the cost of borrowing in the UK. So even if the Bank of England doesn't do anything from here on, the market cost of borrowing is going to be higher, and that poses a potential threat to the housing market and to the economy. But certainly the signs are reasonably positive. Surveys suggest that the economy in the UK is picking up momentum to an extent.
Sarah Hewin from Standard Chartered, many thanks for your thoughts. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.